Money originates from a consensus. Money can be shells, drinks, cigarettes in prison, or it can be state-issued paper currency, numbers visible on a mobile phone, or a set of codes on a hard drive. But ultimately, money is a medium of exchange. What we need is not the money itself, but the resources, products, and services that money can bring us. We need money to buy these things. Similarly, we also earn money through our own labor, production, and services. Our income comes from others' spending, and our spending becomes others' income. Once a transaction begins, the entire economic system starts to operate. As transactions grow, companies become more important in the economy. Our income and consumption are channeled through companies. In this process, the government creates a stable trading environment by providing infrastructure and social security, allowing money to generate trust. You'll find that for individuals, enterprises, or the government, there are only two things about money: income and expenditure. The value of all products and services created by the country is what we call GDP, gross domestic product. We can also understand GDP as our total income. Over the past 30 years, China's GDP has increased 54 times from 20 trillion to 1.2 trillion, and everyone has become wealthier. This is a remarkable economic record. Looking back from today, a question arises. Products and services do not appear out of thin air. So if one person's income is another's expenditure, where did all this extra money come from? I'm Meng Yan. This is an investment video, but I promise it's different from any you've seen. In the past decade, I've seen too many videos on investing. Most discuss trends, making money, picking stocks, and choosing investments. But in reality, investing looks different. Look at the projects we've pursued. 2015's A-shares, 2020's surging funds, and 2021's cryptocurrencies. They brought a lot of real losses and also caused many people to develop a psychological shadow over the word investment. We found that investment is always packaged as a magical box where you just throw money in and it spits out more money. But this is not true investment. What this video wants to answer is what investment really means and what kind of force allows us to make and lose money in the market. What exactly are we investing in when we invest? This is the story of Xiao Wang, who from first grade in elementary school to sophomore year in high school never seemed to catch on, always scoring 1 point. In sophomore year, despite trying hard, he only managed 10 points. Very consistently. In his junior year, due to a chance encounter with a famous teacher and suddenly obtaining a miraculous brain supplement, his intelligence quickly reached new heights. In the college entrance exam, he astonishingly scored 750 points directly. If the full score wasn't just 750, he could have scored 10 more points. Doesn't it sound incredible? But Xiao Wang's year is actually the true story of human civilization over the past 20 years. This world GDP line chart from All World in Data tells us that for a long time, human GDP was close to a horizontal line, very slow, until the 18th century when the line started to curve upwards, almost forming a straight line, and currently, there seems to be no sign of stopping. Indeed, in the long history of tens of thousands, hundreds of thousands of years, the main reason is the exponential rise in productivity from the industrial and technological revolutions. We can use an egg to represent all market goods. Before the Industrial Revolution, a farmer raised 100 hens, producing at most 30,000 eggs yearly. Today, a farmer can easily manage a modern Xiao Wang chicken co-op with 5,000 chickens, producing 1.5 million eggs yearly. Everyone has eggs too. These extra eggs are turned into extra money through trade. More importantly, advancements in food, energy, and healthcare have supported a larger population, bringing more labor and productivity. Meanwhile, progress in education, transportation, and communication has connected us more closely and fostered more service and wisdom, increasing the efficiency of productivity. All these factors have acted as steps to create the explosion of human wealth in the past 20 years. In short, from a historical perspective, we are lucky to be born in a good era. an era of economic boom and wealth explosion. That's why stock guru Buffett says he won the ovarian lottery. In his words, an old man who only knows how to allocate assets and pick good stocks would have been the most useless person in the world a few hundred years ago, or even in primitive society. However, against the backdrop of overall wealth growth, a new problem has emerged. Our money seems to be becoming increasingly worthless. If your grandma put 10,000 yuan under the bed in 195 for you to buy a house in the future, at 20, you'd find 10,000 yuan can't even buy a bathroom. We can create a table using the annual per capita wage data from the National Bureau of Statistics to see changes in China's average wages over 30 years. For example, urban residents' per capita disposable income rose from 207 yuan in 1992 to 49,283 yuan in 2020. People earn more, but spending has also increased. We can also chart China's per capita consumption over the past 30 years on this table. We see urban residents' per capita consumption rose from 1,672 yuan to 3,091 yuan, a significant increase. Everything's pricier: seafood, meat, housing, eggs from 5 mao to 1 yuan, and bus fare from 1 yuan to 2 yuan. Why? If productivity increased, shouldn't things be cheaper? Because the money circulating in the market is growing faster than hens laying eggs. If the number of eggs increases from 1 million to 2 million, but the money also increases from 500,000 to 2 million, the money supply exceeds demand, and egg prices will rise from 50 cents to $1. This is called inflation in economics. You may have heard this term many times. Simply put, it's what you just saw. Currency circulation increases, prices rise, and purchasing power falls, both in China and the US. From 1802 to 201, the dollar and gold's purchasing power changed. In 20 years, $1's purchasing power dropped to $0.5. Quite unfortunate, especially in the early 1970s, after the Bretton Woods system collapsed and the world shifted from gold to credit standard. Currency and credit expansion became constant. The dollar's purchasing power declines faster. Looking back at human economic history over the past centuries, inflation often occurred due to economic policies, social unrest, or just economic prosperity and GDP growth. If we, like grandma, put money under the bed during rapid economic growth, it may become increasingly worthless. So if money starts to become worthless, then what exactly is valuable? Have you ever thought about why there is interest when you deposit money in the bank? This is actually not a matter of course. For example, in some banks in Denmark and Switzerland, there was a period when saving money earned almost no interest. The reason banks today are willing to pay you interest on your deposits is that they can lend your money out to earn more money at a higher interest rate. And people are willing to pay interest to borrow money from banks because they can invest the money into economic production processes to earn more money. Don't forget that the driving force of economic growth comes from the improvement of productivity. And the improvement of productivity, such as upgrading machinery, requires upfront capital investment. These investments are first made, then turned into raw materials, semi-finished products. More importantly, winning money can be repeatedly lent. Lao Jiang's 10,000 yuan was lent to the cooperative, which paid Xiao Li, the chicken seller. Xiao Li deposited it into the bank, and the bank can continue lending to the cooperative. The money circulating in the market increases, but the actual cash is only 10,000 yuan. These banks provide funds through loans to enhance productivity, which usually leads to the money supply exceeding the total amount of goods and services provided by the economy, thereby driving up GDP. Both continue to rise in a cycle, which is why inflation always occurs and is even inevitable. Now we are very close to the core of the problem. If money becomes worthless, what should we turn it into to make it more valuable? We should invest money where it flows. like a golden egg-laying machine. In a tech boom era where advanced productivity is most valuable, turning money into productivity shares rapid GDP growth dividends. In fact, banks have done this too. Over 20 years, our MB loan balances exceeded 20 trillion, mostly flowing to companies like Zhaowang Jish, representing advanced productivity. For ordinary people, investing in a company is too troublesome. But today, there's a more convenient way: buying Jish's stock. Stock essentially means company ownership. For example, Zhaowang Jish issues 10,000 shares. Each share represents 1/10,000th of company ownership. Before listing, the company can sell or dilute equity for investment. For example, with a 100 million valuation in the A round, it can sell or dilute 10% or 10 shares for 1 million cash to support development. The B and C rounds are subsequent stock transactions based on valuations. This is the 9th round of financing Xiaomi Group experienced before listing in Fukuoka in July 2018. You will see that as the company becomes more valuable, the stock price also rises. Before going public, these stock transactions could only be completed through a few institutions or private individuals, also known as the primary market. Once the bell rings and the stock goes public, it enters the secondary market, and investors like us can buy stocks of Xiaomi and Jish. As long as Jish's productivity increases and orders grow, the stocks become more valuable. So, can we enjoy the dividends of technological development and productivity improvement? It sounds very reasonable, but in reality, it's not that simple. A sad fact is that many people lose money when buying stocks. We can add bonds to this chart of US dollar purchasing power changes, and you'll find they're stronger than gold and the US dollar. You can see bonds as lending money with an annual interest of about 23%, while the true century-long champion is stocks with an average annual return of 6%. Sounds like 6% a year. It seems okay, but if it continues like this for 200 years, the result is astonishing. $1 invested back then would become 700,000 after 200 years. Not only did Professor Io Rui Dingsen from Cambridge University in the US and 2 other economists compile and analyze the investment returns of various assets in over a dozen countries including the US, UK, Germany, France, and Japan over the past 10 years from 190 to 20, concluding that stock investment returns are the best, even in the worst performing stock scenarios. There is an annualized return of 2.5% per year. So, what about China's situation? On December 31, 2009, the A-share closed at 327 points. And 10 years later, on December 31, 2019, the index was as high as 305 points, a decrease of 20 points over 10 years. The conclusion that stocks have the highest today, the A-share index we mentioned is actually the Shanghai Composite Index. Released in 1991 as China's first stock index, widely used as a reference for A-share trends. By March 2003, the A-share markets had about 50 stocks, while the Shanghai Stock Exchange had 2,194 stocks. Only 4% of the total market value, which is 58%, and doesn't represent the entire Chinese stock market. What if we use an index representing all A-share companies? On December 31, 2002, the one all-share index closed at 960 points. 20 years later, this number rose to 4,815 points, over 5 times higher. The average annual return was 8.2%, but low. If we extend the time to 195 years on this RMB purchasing power chart, we'll see similar results to other countries. This is logical. Behind stocks that go public and circulate, many are excellent companies. They represent China's economic achievements and productivity improvements over 13 years, aligning with China's soaring GDP curve. The data looks good, but there's an old stock market saying, 1 gains, 2 break even, 7 lose. It seems most people trading stocks are losing money. If we re-examine the 2015 A-shares, we'll find the stock market's pricing mechanism doomed most investors to losses. From July 2014, starting at 2,364 points, The Wind All-Share Index surged to 5,470 points in less than a year, peaking at 7,724 points on June 12, 2015, with a 305% increase. However, most investors didn't make any money. In early 2014's bull market, most investors reduced holdings after years of waiting to break even. Capital inflow was restrained, but as prices rose, many investors re-entered the market months before the peak. From April to May 2015, over 1.6 million opened stock accounts on the Shenzhen Stock Exchange. And in June alone, Chinese investors bought 36 trillion yuan in stocks, 12 times the previous year. The outcome was null. In 1 week, the index fell 14%, plummeted 50% in 3 months, with 3 instances of thousands of stocks hitting limit down. The bull market became a bear market. Why did stock prices fluctuate so drastically? Because everyone can participate in pricing. Assuming Xiao Wangji issues 100 million shares on the A-share market at 20 yuan each. If someone wants to buy 10 shares at 20 yuan, but the seller wants 20.1 yuan, the transaction fails and the price stays at 20 yuan. Once someone buys at 20.1 yuan, the transaction completes and the price rises to 20.1 yuan. Conversely, if someone sells lower, the price falls. When involved in stock pricing, each investor predicts the future, essentially forecasting other investors' expectations. People expect prices to rise because they predict that others also expect prices to rise, so they buy. If prices do indeed rise, their expectation of a price increase is realized, which drives prices to continue rising. At this point, a self-fulfilling bubble appears. Without much external force, this bubble can grow larger in a spiral of rising expectations until it bursts. So you'll find that, because of marginal pricing in the stock market, extreme prices are often set by those who understand its value least. Their expectations and emotions cause short-term stock price swings. Why short-term? If you overlay the net asset curves of all A-share companies over the past 20 years, you'll find the line is very stable, with almost no fluctuations. Although stock prices may fluctuate significantly in the short term, they will eventually return near the net asset price. A stock's price consists of intrinsic value and valuation. The intrinsic value changes with the company's long-term development, while valuation fluctuates with market expectations and sentiment. Let's return to June 2015. At that time, how outrageous were the valuations? If calculated using the median PB of the entire market stocks, the average was greater than 4. This means that more than half of the companies had a market value more than 4 times their net assets, far exceeding the normal 1 to 2 times. Buying any stock at such prices is likely to result in a loss. Don't forget, the essence of investing is to buy something cheap and sell it when it's expensive. Since most investors are easily influenced by emotions and unable to price accurately, leading to losses, what did those who made money in the stock market do? In the stock market, we often hear stories of getting rich overnight. Some make money buying stocks, and others help them, known today as fund managers. Do these professionals really profit? If so, how? A simple experiment can tell us the answer. We selected 104 fund managers from various Chinese institutions and charted their fund performance from 2013 to 2017. This line represents their average annualized return over 5 years. The vertical axis shows their deviations from the average, and the horizontal axis shows the ranking of these deviations. Imagine how top-ranked funds promote their strategies and research. With good results, these seem reliable. For ordinary investors, choosing top-ranked funds seems reasonable. But what will the result be? We changed the vertical axis to the 2018 to 2020 performance difference of these fund managers, but the horizontal axis still shows their 2013. It's clear the previous order ended instantly. The current distribution seems random, showing no difference in abilities. For ordinary investors, buying a fund that ranks high and other funds actually makes no difference. Previously, the funds at the bottom of the rankings might even have better returns. Therefore, This exam tests short-term prediction skills, not learning ability. These funds have themes, leaning towards consultant-advised industries or sectors. Ultimately, their ranking depends on which a sheer industry excels this year. For example, by charting the performance of indices like real estate, computers, food and beverages, and coal based on their fluctuations from 201 to 20 over this 1 year, you'll find that if an industry fund does well this year, it doesn't mean it will next year. If it does poorly this year, it's more likely to rebound next year. Buffett once told an interesting story about fund managers. Suppose all American companies are owned by a large family, which we call the G family. Year after year, as these companies continued to grow, by 205, the companies owned by the G family were earning more and more, reaching $7 billion. The members of the G family increased their wealth at the same rate according to their respective shares, living happily and harmoniously. However, at this time, a few helpers appeared. The first helper told some members of the G family that they were smarter and more capable than others, and that they could buy some good companies from them and sell some not-so-good companies to them. So everyone started trading their stocks. The second helper said that choosing good companies was too difficult, and that they could hire them to help. So everyone started looking for people to help select stocks. The third helper said that choosing helpers was actually a very professional matter, and that they could help choose stock managers. In this way, helpers A, B, and C began to charge various service fees and performance commissions. Actually, the members of the G family only need to lie down every day and do nothing to obtain all the profits. But now a large part of the profits created by British capital is taken away by these helpers. This is not entirely a prophetic story. In 2005, the total friction cost of the helpers has reached 20% of the total profits of all American companies. This is another counterintuitive thing. Making money in the stock market can actually be easier. Just lie down and buy the index. An index is a stock basket, like the Shang 30, representing 30 top companies in Shanghai and Shenzhen markets. Buying it equals buying these 30 stocks. From 2005 to 2020, the Shang 30's average annual return was 9.84%, while Wong's Mixed Fund Index return was 14.07%. Just hold long-term to approach these million-dollar salary traders. This isn't luck, but it's hard to say it relates to skill. It's because you boarded China's economic expenditure ship. If you look at major mature stock markets globally, you'll see the chance of professional fund institutions achieving above market average returns and beating index performance decreases over time. However, if you want excess returns beyond this, you can do two things. Stock selection and market timing. As the name implies, stock selection means choosing good stocks, and market timing means choosing the right time to buy. This largely tests your true ability, testing whether you really know something more than the market. But do we really know more than the market? What level do we need to achieve in order to obtain stable and predictable excess returns? In 1976, biologist and mathematician Robert May published a paper in Nature titled Simple Mathematical Models with Very Complicated Dynamics. This paper discussed a seemingly simple formula, the logistic map, which looks like this. We only need to set the values of x0 and a, and this formula can keep running, calculating x1, x2, x3, and so on endlessly. If we set a22 and x0 to 0.2, we can calculate x1 as 0.32. Substituting x1 into the formula gives x2 as 0.4352. After several iterations, x4 will reach 0.5 and remain unchanged in subsequent iterations. In fact, regardless of x0, if it equals 2, it will end with xn equaling 0.5. But if it increases, like when a is 3.1, things change. Then xn will jump between 2 points. If it increases a bit more, the cyclic hopping points will become 4, 8, 16. Until a is greater than or equal to 3.5694, the cycle period becomes infinite. At this moment, the entire logis mapping undergo a qualitative change because before this, xn had a predictable cycle pattern. Once the initial value is set, they are predictable. But after this, XN becomes unpredictable. XN no longer enters periodic oscillations but instead enters an elusive random state. Taking A equal to 4 as an example, you'll find that just a 0.1 difference in the initial value can lead to a completely different trajectory result in the old JS mapping, truly illustrating a miss is as good as a mile. This is the chaos system. Robert May concluded that in a chaotic system, no matter how close the initial conditions are, their trajectories will eventually diverge after a sufficiently long time. This means that even if our model is simple and all parameters are completely determined, long-term prediction is still impossible. In 1976, this was a shocking fact that influenced many later scientists and became one of the starting points for the new discipline of complex systems. Today, we can find various chaotic systems in life, like weather and the stock market. For instance, we can see XN as the current weather, then A means the rate of change. Thousands of independent behaviors converge to determine weather changes and trends. Today, humans can accurately predict when a probe will reach Mars, yet still cannot predict tomorrow's weather accurately. This is because weather, like the logistic map, is extremely sensitive to initial conditions. Only precise information observations can lead to accurate predictions. Compared to weather, the stock market is more complex because our predictions don't affect weather but do impact the stock market's direction. Human sentiment adds complexity, making it a second-order chaotic system. This explains why many active fund managers, despite extensive research and analysis, still can't beat the index, as the market's complexity surpasses researchers' analytical precision. In a chaotic system, even a slight deviation in initial conditions can lead to opposite predictions. Of course, we can still see exceptions like Buffett. The reason is they provide insights beyond the market average within their competence, achieving excess returns through stock splits. However, most star investors eventually return the money they earn. The competitive curves of Cathie Wood and Bill Miller are their stories. So in the formula where returns equal the market plus stock selection plus timing, we can't force ourselves to predict the future. We can't precisely determine when and by how much prices will rise. We can make higher probability decisions, which is key to successful investing. This chart shows the Wind Equity Index from 2005 to 2020, based on stock valuation indicators. We can quantify daily market sentiment, creating a line that divides sentiment into low, medium, and high zones. Higher temperatures mean a hotter market, indicating high stock valuations, like the Forex PB period in June 2015, which is in the high zone. And if everyone lowers stock valuations, the temperature will drop too, meaning prices may be below intrinsic value, increasing profit chances. In our statistics, the profit probability for buying and holding for 5 years is over 95%, making it a good time to buy. Observing market sentiment from a longer-term view can help us buy assets cheaper and boost investment success. Now we have good assets and good prices. Only one final question remains: when to sell? The answer is to hold for the long term. In the 2022 Public Fund Investor Profit Insight Report, transaction data from 6 hosting institutions offer insights. The first finding is that longer holding periods yield higher returns. Holding period under a month, clients' average annual return is -4.59%. Holding positions for 1 to 2 years yields an average annualized return of only -1. If the holding period exceeds 2 or 3 years, returns of 2.65% and 6.52% can be achieved. This experiment explains why. From 203 to 20 years, missing the highest stock market gain days results in less profit. Missing the top 5 gain days, Shanghai Shenzhen 30 and Wind All-A annualized returns drop to 4.3% and 6.17%. More missed days mean lower returns. If you miss the top 30 gain days, even holding Husheng 30 and Wind Rights for 20 years, returns drop to -2.58% and -1.5%. Over 20 years, with about 480 trading days, returns depend on those 30 days. Just 0.6%. Returns are unevenly distributed over time. If enduring volatility is the ticket to enter the stock market, these crucial days are our reward for staying in the market. This is why the longer the holding period, the higher the returns. Only in this way can we not miss out on these high gain days. But unfortunately, in this report, about 58% of investors hold positions for less than a year, and only 2.81% hold for 1 to 2 years, while those holding for 2 to 3 years or more than 3 years is just 7.42%. The investment community often says when lightning strikes, you'd better be there, but most can't stand the loneliness and restlessly keep going in and out, avoiding the lightning. Just like Graham wrote in The Speculator from The Villager, investing is not about beating others at their game, but about controlling yourself in your own game. Starting from 205, I have been learning about investing for 18 years. I once thought I would understand more and more about investing and the market. But on the contrary, the longer I survive in the market, the more I realize there will always be things beyond my imagination. The future is unknown. Today, we live in an era full of uncertainty. Geopolitical conflicts, extreme weather, Sino-US disputes, plans change, expectations change, and trends change. It seems everything is changing, but some things never change. They are Zhao Wangjish, representing advanced productivity, the monetary volume rising with GDP, fund managers targeting A-shares, logistics mapping running a chaotic system, buying and selling with emotions, and our investment strategy of unity of knowledge and action, good assets, good prices. Long term, I don't know what 203 will be like, but I know that in the future, when you reopen this video in times of confusion, fear, or greed, the advice we discussed today about money and investment will still be effective. These unchanging things let us face the present calmly and embrace the future. This is what investing taught me.